Look, I'm not going to sugarcoat this. What's happening in the gold market right now is something most people won't recognize until it's too late. And by too late, I mean when gold is trading at levels that make today's prices look like the bargain of the century. Right now, as I'm recording this, gold just smashed through $4,400 per ounce. Let that sink in for a second. $4,400. And here's what nobody's talking about. This isn't just another rally. This is the beginning of a structural shift in how the world values money itself. You see, there's this thing happening behind the scenes that most retail investors have no clue about. While everyone's been distracted by stock market headlines and crypto drama, the world's central banks have been quietly accumulating gold at a pace we haven't seen in over half a century. We're talking about an eye-watering buying spree that's fundamentally changing the supply-demand dynamics of this market. The World Gold Council just released their full-year data, and the numbers are staggering. Central banks aren't just buying gold, they're hoarding it like their currencies depend on it. Because guess what? They do. Think about what a central bank actually is for a moment. These are the institutions that control the money supply of entire nations. They have access to every piece of economic data, every geopolitical intelligence report, every financial projection that exists. They know things we don't. And when you see them all moving in the same direction at the same time, you need to pay attention. Here's what's really fascinating. The LBMA gold price hit 40 new record highs this year alone. 40. That's not a bull market. That's a systematic repricing of monetary assets. And each one of those record highs represents another moment where someone said, you know what? I don't care what gold costs. I need to own it. But let me take you back for a second because understanding where we are requires understanding how we got here. In 1971, President Nixon did something that changed the world forever. He closed the gold window. Suddenly, for the first time in history, the entire global financial system was running on pure faith. No gold backing, no hard asset foundation. Just trust in governments and central banks to manage paper currencies responsibly. And for a while it worked. Or at least, it seemed to work. But here's the thing about systems built on faith. They only function as long as everyone believes. The moment that belief cracks, everything changes. Fast forward to 2008. The financial crisis hits, and suddenly the Federal Reserve is creating trillions of dollars out of thin air. Quantitative easing, they called it, a fancy term for printing money. And not just the Fed. Central banks around the world joined in. The European Central Bank, the Bank of Japan, the Bank of England. Everyone was printing. Gold responded exactly how you'd expect. It rallied from around $800 an ounce to over $1,900 by 2011. People saw what was happening. They understood that when you create money without creating value, the money becomes worth less. But then something interesting happened. Gold got crushed. From 2011 to 2015, it fell all the way back to $1,050. And everyone said the gold bull market was over. The dollar was strong. The economy was recovering. Who needs gold? Except the central banks never stopped buying. Even when the price was falling, even when sentiment was terrible, even when every financial advisor was telling their clients to sell their gold and buy stocks, central banks kept accumulating. Why? Because they knew something the retail market didn't. They knew the money printing wasn't over. They knew the debt levels were unsustainable. They knew that eventually the bill would come due. And now, here we are. Gold isn't just making new highs. It's accelerating. The moves we're seeing aren't gradual. They're explosive. And the driver isn't retail investors or even hedge funds. It's institutions. It's sovereign wealth funds. It's central banks that are supposed to be the guardians of fiat currency, and they're buying gold like they don't trust their own system. Let me paint you a picture of what's actually happening in the physical gold market right now, because this is where it gets really interesting. The COMEX, that's the major futures exchange where gold trades in New York, has been showing some unusual patterns. The amount of gold available for delivery has been declining while open interest has been rising. In simple terms, more people want physical gold than there is gold available to deliver. Now, the paper gold market is massive. You can trade gold futures, gold ETFs, gold certificates, all kinds of financial instruments that represent gold without actually being gold. And for years, this worked fine. The paper market and the physical market moved together. The price was the price. But something's changing. We're starting to see disconnects. Premiums for physical gold, the amount you pay above the spot price to actually get your hands on real metal, have been widening. In some markets, particularly in Asia, you're paying significantly more than the quoted price just to get physical delivery. This is what happens when the paper market and the physical market start to diverge, And historically, when that happens, the physical market always wins. Because at the end of the day, you can't eat a futures contract. You can't hold an ETF in your hand. When push comes to shove, physical gold is what matters. And the smart money knows this. That's why central banks aren't buying gold ETFs. They're taking delivery of physical bars and storing them in their own vaults. They're repatriating gold that was stored in other countries. Germany spent years moving hundreds of tons of gold from New York and Paris back to Frankfurt. Why? Because when things get uncertain, you want your gold where you can see it. Now, let's talk about what's driving this current surge. Because it's not just one thing. It's a perfect storm of factors all converging at once. First, you've got interest rate expectations. The Federal Reserve has been signaling rate cuts, and the market is pricing in multiple cuts over the coming months. When rates fall, the opportunity cost of holding gold decreases. Gold doesn't pay interest, so when bonds are yielding 5%, gold looks less attractive. But when rates are falling and real yields are negative, suddenly gold becomes the smart play. Second, you've got geopolitical instability at levels we haven't seen in decades. I'm not going to get into specific conflicts or political situations, but let's just say the world feels less stable than it has in a long time. And when the world feels unstable, people buy gold. It's been that way for thousands of years, and it's not changing now. Third, and this is the big one, you've got the de-dollarization trend. Countries around the world are actively working to reduce their dependence on the US dollar. The BRICS nations, Brazil, Russia, India, China, South Africa, have been talking about creating alternative payment systems. They're settling trade in their own currencies. They're building financial infrastructure that bypasses the dollar entirely. And what are they using as the foundation for this new system? Gold. Because gold is the one asset that every country recognizes as valuable. It's not dependent on any government. It's not subject to sanctions. It's universal money. China's been particularly aggressive about this. They've been building up their gold reserves for years, and most analysts believe their official numbers significantly understate how much gold they actually own. Why would they hide it? Because if the market knew the true extent of their accumulation, it would drive the price up even faster. Russia's another interesting case. After the sanctions following the Ukraine situation, Russia found itself cut off from the Western financial system. Their dollar reserves were frozen. Their access to SWIFT was restricted. But their gold, nobody could touch that. And that lesson wasn't lost on other countries. If you want true financial sovereignty, you need assets that can't be frozen or seized. Gold fits that bill perfectly. Now here's where this gets personal for you, because this isn't just about central banks and geopolitics. This is about your wealth, your savings, your financial future. Think about what's happened to the purchasing power of the dollar over the last few decades. A dollar today buys a fraction of what it bought in 1980 or 1990 or even 2000. That's not an accident. That's the result of monetary policy that prioritizes short-term economic stimulus over long-term currency stability. And it's accelerating. The money supply has exploded. Government debt is at levels that would have been unthinkable a generation ago. The only way out is either default, which is politically impossible, or inflation, which is politically palatable because most people don't understand it. Gold is how you protect yourself from that. It's not about getting rich quick. It's about preserving what you've already earned. It's about making sure that the money you've saved over decades of work doesn't evaporate because of decisions made by politicians and central bankers. Quick aside here. If you're sitting on a significant amount in retirement accounts, $100,000 or more, you might want to look into how gold IRAs work. I put together a free guide that covers the mechanics. How to get physical gold into your retirement account without triggering tax penalties, what the rules are, how the process actually works. It's in the description below. Not trying to sell you anything, just information that might be relevant to your situation. Worth checking out if you're thinking about this stuff. Anyway, back to where this market is headed, because that's what really matters. The technical picture on gold is absolutely screaming right now. We've broken through every major resistance level. The $4,400 level that just got taken out, that was supposed to be a ceiling. It was supposed to be where sellers would come in and push the price back down. Instead, it got obliterated like it wasn't even there. And here's what's interesting about technical breakouts in gold. Unlike stocks, where a breakout might fizzle after a few days, gold breakouts tend to run. They tend to run hard and they tend to run long, because the buyers in gold aren't day traders looking for a quick flip. They're institutions making strategic allocation decisions. They're central banks implementing policy. They're sovereign wealth funds repositioning for the next decade. When those players start buying, They don't stop because the price went up 5%. They keep buying until their allocation targets are met. And right now, based on the flows we're seeing, those targets are nowhere near being met. Let me give you some context on what expensive means for gold, because I keep hearing people say gold is too high to buy now. They said that at $2,000. They said it at $3,000. They're saying it at $4,400. And they'll be saying it at $5,000 and $6,000 too. But here's the thing. Gold isn't expensive or cheap in absolute terms. It's expensive or cheap relative to other things. Relative to the money supply, gold is actually still historically cheap. The M2 money supply, that's a measure of all the dollars in circulation, has grown exponentially. But gold production has been relatively flat. More dollars chasing the same amount of gold means the price has to go up. It's not complicated. Relative to stocks, gold is also still reasonable. The gold to S&P ratio, which measures how many ounces of gold it takes to buy the S&P 500 index, is still well below its historical peaks. In 2011, it took about 0.6 ounces of gold to buy 1 unit of the S&P. Today, even with gold at record highs, that ratio is higher, meaning stocks are still expensive relative to gold. And relative to real estate, gold is definitely not overvalued. The median home price in the U.S. is around $400,000. That's less than 100 ounces of gold. Back in 2011, when gold was at its previous peak, you could buy a median home for about 200 ounces. So in gold terms, real estate has actually gotten cheaper. What does all this mean? It means gold isn't in a bubble. It's in a repricing. The world is figuring out what gold should be worth in an era of unlimited money printing, massive government debt, and declining trust in institutions. And that price is a lot higher than where we've been. Now, let's talk about silver for a minute, because what's happening in silver is even more dramatic than gold. Silver just hit record highs, and the silver to gold ratio, how many ounces of silver it takes to buy 1 ounce of gold, has been compressing. Historically, that ratio has averaged around 60 to 1, meaning 60 ounces of silver equals 1 ounce of gold. But it's been as low as 15 to 1 and as high as 100 to 1 depending on market conditions. Right now, we're seeing that ratio come down, which means silver is outperforming gold. Why does this matter? Because silver is both a monetary metal and an industrial metal. It's used in solar panels, electronics, medical applications, and countless other industrial processes. As the world electrifies and moves toward green energy, silver demand is exploding. But silver supply is constrained. Most silver comes as a byproduct of other mining operations, so you can't just ramp up silver production quickly. This creates a situation where industrial demand is competing with investment demand, and when you have central banks buying gold, retail investors often follow by buying silver because it's more affordable. A silver squeeze, where industrial users are competing with investors for limited supply, could send silver prices parabolic. We saw a preview of this in 2021 with the whole Wall Street bets silver squeeze attempt. It didn't work then because the market wasn't ready, but the fundamentals that made people excited about silver then are even stronger now. The difference is, now you have institutional money getting involved. Now you have supply deficits that are real and measurable. Now you have a setup that could actually deliver the kind of move people were hoping for. But let's get back to gold, because that's the anchor of this whole trade. Gold is what central banks buy. Gold is what sovereign wealth funds accumulate. Gold is the ultimate monetary asset. And here's what people need to understand about gold in a crisis. Gold doesn't just go up when things are bad. Gold goes up when people realize things are bad. There's a lag. There's a period where the problems are building, but nobody's paying attention. And then there's a moment of recognition, where suddenly everyone sees it at once. And that's when gold explodes. We saw this in 2008. The financial crisis actually started in 2007. But gold didn't really take off until 2009, 2011, after people realized how serious it was. We saw it in the 1970s. Inflation started creeping up in the late 60s, but gold didn't really run until the mid-70s, after Nixon closed the gold window and people realized the dollar was no longer backed by anything. The question is, where are we in that cycle now? Are we in the early stages, where problems are building but most people don't see them? Or are we in the recognition phase, where the smart money is moving, but the crowd hasn't caught on yet? Or are we in the late stages, where everyone knows what's happening and it's too late to get in at good prices? Based on what I'm seeing, we're somewhere between the early and middle stages. The smart money is definitely moving. That's what the central bank buying tells us. But the retail crowd isn't here yet. Your average person on the street isn't talking about gold. They're not worried about currency debasement or monetary policy. They're worried about their jobs and their bills and their day-to-day lives. But that's changing. As gold makes headlines, as the price keeps climbing, as more people start asking questions about why this is happening, that's when the retail wave comes. And when retail investors start piling into gold, when your neighbor is asking you how to buy gold coins, when financial advisors who've been skeptical for years suddenly start recommending gold, that's when you know we're in the late stages. We're not there yet, which means there's still time. But the window is closing. Let me tell you about what happened in 1980 because it's instructive. Gold went from $35 an ounce in 1971 to $850 in 1980. That's a 24x increase in less than a decade. And it wasn't a straight line. There were pullbacks, corrections, moments where people thought the rally was over. But the underlying fundamentals, high inflation, currency instability, geopolitical tension, kept driving it higher. The peak came in January 1980, and it was driven by a combination of factors: the Soviet invasion of Afghanistan, the Iranian hostage crisis, inflation running at double digits, and most importantly, a loss of confidence in the dollar and in government's ability to manage the economy. Sound familiar? Now, I'm not saying we're going to see a 24x move from here. The market is different now, the world is different, but the principles are the same. When people lose faith in paper currency, they turn to hard assets, and gold is the ultimate hard asset. After 1980, gold crashed. It fell all the way back to $250 by 1999. And for 20 years, gold was a terrible investment. People who bought at the top in 1980 didn't break even until 2007. That's a long time to wait. But here's the key difference between then and now. In 1980, Paul Volcker raised interest rates to 20% to break inflation. He made the dollar scarce. He made it expensive to borrow. He created a recession to wring inflation out of the system. And it worked. Inflation came down, the dollar strengthened, and gold fell. Can they do that today? Can the Federal Reserve raise rates to 20% when the government is carrying $35 trillion in debt? When every percentage point increase in rates adds hundreds of billions to the annual interest expense? When the entire economy is built on cheap money and low rates? No, they can't. Which means the playbook that worked in 1980 isn't available now. They're trapped. They can either let inflation run, or they can raise rates and crash the economy and bankrupt the government. Those are the options. And that's why this gold rally is different. It's not speculative. It's not driven by fear of a temporary crisis. It's driven by the recognition that the system itself is unsustainable, that the debt can never be repaid, that the only way out is to inflate it away. And that gold is the way to protect yourself from that outcome. The COMEX mechanics I mentioned earlier are worth diving into a bit more because they reveal something important about how this market actually works. The COMEX is where most gold futures trading happens. It's a paper market where contracts representing gold are bought and sold. Most of these contracts never result in physical delivery. They're just bets on the price. But there's a mechanism for delivery. If you hold a futures contract to expiration, you can demand physical gold, and the exchange has to deliver it. They maintain warehouses with gold bars specifically for this purpose. Now, here's where it gets interesting. The amount of gold in COMEX warehouses has been declining. At the same time, the number of contracts demanding delivery has been increasing. This creates stress on the system, because if everyone who holds a contract decides they want physical gold, there isn't enough to go around. This is what's called a squeeze, and we've seen hints of it in other markets. The silver squeeze attempt in 2021 was based on this exact dynamic. The idea was that if enough people demanded physical delivery, the paper market would break and the price would explode. It didn't work in silver because the market makers had enough inventory to meet demand. But the fact that people are even thinking about this tells you something. It tells you there's skepticism about whether the paper market truly represents the physical market. And that skepticism is growing. In London, where the LBMA operates, that's the London Bullion Market Association, the other major gold trading hub, you're seeing similar dynamics. Premiums for physical gold have been elevated. Delivery times have been extending. These are signs of tightness in the physical market. And when the physical market gets tight, the price has to rise. Because unlike paper contracts, you can't just create more physical gold. It has to be mined, refined, and delivered. And that takes time and money. Global gold production is around 3,000 tons per year. That sounds like a lot, but it's actually not that much when you consider global demand. Central banks alone have been buying over 1,000 tons per year recently. Add in jewelry demand, industrial demand, and investment demand, and you're looking at a market that's in deficit. A deficit means more gold is being consumed than is being produced. And the only way to balance that is through higher prices. Higher prices incentivize recycling, people selling old jewelry, scrap gold, etc. Higher prices also incentivize new mining projects. But both of those take time. In the short term, a deficit means the price has to rise to ration the available supply. And that's exactly what we're seeing. Now let's talk about what this means for different types of investors, because the strategy depends on your situation. If you're young, with decades until retirement, gold should be a core holding but not your entire portfolio. Maybe 10 to 20% in physical gold and gold mining stocks. The rest in productive assets, stocks, real estate, businesses. Because over very long time periods, productive assets tend to outperform. But gold is your insurance policy. It's what protects you when everything else is falling apart. If you're middle-aged, getting closer to retirement, your allocation should probably be higher, maybe 20-30% in gold and precious metals, because you don't have as much time to recover from a major market crash. You need stability. You need assets that will hold their value even if stocks get cut in half. And if you're already retired, living off your savings, gold becomes even more critical, because you can't afford to lose 30-40% of your portfolio value. You need that money to live on. Gold provides stability and purchasing power protection that stocks and bonds can't match in an inflationary environment. The form of gold matters too. Physical gold, coins and bars, is the most direct way to own it. You have it in your possession. Nobody can freeze it or seize it or devalue it with a keystroke. But it's not very liquid. You can't easily sell a gold bar to pay your electric bill. Gold ETFs are more liquid. You can buy and sell them instantly in your brokerage account. But you don't own physical gold. You own shares in a fund that owns gold. And in a real crisis, there's counterparty risk. What if the fund doesn't actually have all the gold it claims to have? What if there's a run on the fund and they can't meet redemptions? Gold mining stocks are leveraged plays on the gold price. When gold goes up 10%, mining stocks might go up 20% or 30%. But they're also riskier. They're subject to operational issues, management decisions, political risk in the countries where they operate. They're stocks, with all the volatility that entails. The right mix depends on your goals and risk tolerance. But the key is to have some exposure. Because if gold does what I think it's going to do over the next few years, you want to be positioned for it. Let me give you a scenario to think about. Let's say gold goes to $6,000 an ounce over the next 2 years. That's about a 35% increase from current levels. Not crazy by historical standards. Gold went up more than that in 2020 alone. If you have $100,000 in savings and 10% in gold, that's $10,000. A 35% gain gives you $3,500. Nice, but not life-changing. But if you have 30% in gold, that's $30,000. A 35% gain gives you $2,500. Now we're talking about meaningful money. And if gold goes higher, say $8,000 or $10,000, those numbers get even more significant. A 100% gain on a 30% allocation is a 30% gain on your entire portfolio. That could be the difference between a comfortable retirement and a struggling one. But here's the thing. You have to position yourself before the move happens. Once gold is at $6,000 or $8,000, it's too late. The easy money has been made. You're buying at the top, hoping for more gains. And that's when you get hurt. The time to buy gold is when it feels uncomfortable, when people are skeptical, when financial advisors are telling you it's a barbarous relic with no place in a modern portfolio. That's when you buy. And right now, even with gold at record highs, we're still in that window. Because the fundamentals are just getting started. The central bank buying isn't slowing down. The geopolitical tensions aren't resolving. The debt isn't getting paid off. The money printing isn't stopping. All the factors that drive gold higher are still in place, and they're intensifying.